Each year, there are some key changes that you need to know about before you lodge your tax return. In this video, I'm going to be going through the key aspects that have changed for the 2023/2024 tax returns, and also covering some of the key things that haven't changed. Let's kick it off with the motor vehicle cents per kilometre rate. This has changed and it has gone up, which is great for people that claim under this method. So the rate was previously 78 cents for the 2022/2023 year. It will now be 85 cents for the 2023/2024 year. Now, this means that those that are claiming the maximum kilometres under this method, which is the 5,000 kilometres, will see their claim go from $3,900 up to $4,250. So giving you an extra $350 claim. Now, just remember, just because you've got an extra deduction doesn't mean that's how much extra you'll get back. So you'll receive the extra back at your tax rate. So if you're on the 32.5 cents plus the 2% Medicare levy, so 34.5 cents, the average tax rate for a lot of people, then you will receive an extra tax benefit from that extra $350 deduction of $120.75. So still better than nothing, and obviously with the increased cost of fuel over the last 12 months, this is why they have updated the rate. Now just remember, you can't just go ahead and claim 5,000 kilometers just because that's the maximum. You still need to show how you've calculated your claim. So obviously if you've done more than 5,000 work-related kilometers, there are no issues with claiming 5,000. But if you've only done 2,000, you can only claim 2,000. Now just remember the ATO are very strict in this area on what classes as a work-related kilometer. So you can't just claim your work travel from your house to your workplace in most situations. There are some exceptions if you're carrying bulky tools or maybe you have an irregular place of work. Make sure you go and do research onto how the motor vehicle claims actually work, because especially when a rate's going up, it means that the deduction's going up, which means if you get it wrong, there's a larger impact to you. And don't forget, compare the motor vehicle cents per kilometre against the logbook method to work out what works best for your situation. The second key change is the Medicare levy surcharge thresholds have changed. And this is long overdue because these haven't changed for a while. And of course, another good thing, they're going up. So let's look at the different thresholds here. And the key one that most people want to know about is what's the lowest one. So for singles, it's gone from $90,000 up to $93,000, and for those that are a family, it's gone from $180,000 up to $186,000. So this is the level where if you are over that income and you don't have hospital private health cover, then you will pay the Medicare levy surcharge. If you're under this income, it doesn't matter, you won't pay the Medicare levy surcharge at all, no matter whether you have private health hospital cover or not. So this is something that definitely stings people where their income starts to creep up and all of a sudden they've earned, say, $96,000, they get stung with this Medicare levy surcharge of 1% of their Medicare levy income. So it can be quite hefty because it's something where it can be zero, and then as soon as you go over the threshold, you're paying 1% of, $93,000, so you're talking $930. So it is something to be mindful of if you're near these brackets, but just be aware the brackets have gone up. Now, something to remember when it comes to the Medicare levy surcharge is if you go and get hospital private health cover, you won't pay it. But this kicks in from the day you get it. So if you rush out and get it the last week of June, it's not going to help you much in this financial year because you only have that coverage for, say, 7 days out of 365 days. So you'll still pay the Medicare levy surcharge for the time you didn't have the private health hospital cover. Now, obviously, if it's going to be something that affects you for the next year, well, you might as well get it now rather than wait till 1st of July because you're going to get a little bit in this year and then all of next year you've got the cover so you won't pay the surcharge. Now, as we're coming to tax time, I am excited to say that we have now opened up bookings for my business, Rooshock Accounting. So we are taking tax return bookings. You can find out all the details through our website. We helped close to 1,000 people with their tax returns last year, so we're excited to see that number grow further. Now let's get back into the video. So one of the key things that hasn't changed is the impacts on the tax rate changes for 2024/2025 won't impact your 2023/2024 tax return. So you'll see a lot of media around. I've even done a video on the tax changes, so you can go and check that one out. But there has been a lot of talk around these tax rate changes, and a lot of people are going to get confused and think that means they're going to get extra tax back because people are going to be talking about the tax savings you're going to have. But these do not impact your 2024 tax return that you're about to lodge. That is because these changes only come in from 1st of July, so they're not an additional refund that you'll get, unlike some of the changes we've had in the previous years that have increased the average refund. This also means that because they are tax cuts, it means that from 1st of July, the first full pay run you have in the new financial year, you'll receive these benefits on an ongoing basis because they will change the tax withholding tables, so therefore you'll have slightly less tax withheld each pay run. So this means that when we come to this time next year and you go to lodge your tax return, don't expect a large refund because you've already received those tax cuts as you go in each week. because it's going to reduce your withholding on a weekly basis or a pay run basis, which means that you're not going to just go and receive a large extra tax refund. It can be a little bit confusing because the media are not very good at explaining this, but it is just something to be aware of. So the other key area that hasn't received any changes here is the home office rates. So I'm going to be mainly talking about the fixed rate method, and this is because this underwent a major change in the prior financial year, so for your 22/23 tax returns. So the fixed rate method is staying at 67 cents. As far as I'm aware, there's been nothing else announced to change that. And this means that you still need to understand what is included in the fixed rate, because it's very easy to get this wrong. So the fixed rate method includes your home internet, includes any mobile internet you're paying for, it includes your mobile phone expenses, it includes your electricity and gas costs, and it includes your stationary costs. So if you're claiming under the fixed rate method, you can't claim any additional amounts for these. It doesn't include things like decline for depreciating assets. You can still claim these on top of your fixed rate method. So the key thing here is the ATO is scrutinizing this. It is on their hit list because they know people are getting it wrong. They know people are claiming the fixed rate method plus their phone, for instance, and you can't do that now. You could previously do that under the old fixed rate method a couple of years ago. The other key thing in this area is you need to have a record of all of the hours you've done throughout the year. So because you're claiming on a per hour basis, you need to show exactly how you calculated those hours. You can't just say, I work 4 hours a week on average across the year. You need to show how many hours you've actually done. Timesheets are great for this. Obviously very easy for those that work full-time from home because they can show how many hours they've worked for the year. That's easy. But if your hours change each week, you need to show how you have actually calculated this, not just averaging it out. I did mention something about the ATO hit list, and that is because there are certain areas that you should focus on more so when it comes to your tax return because they may be on the ATO hit list. In this upcoming video, I talk about the ATO hit list for the 23-24 year, what the key areas of focus are, and how you can ensure that you're covering yourself when it comes to these areas.